Welcome to the Deep Dive, the show that really tries to get you truly well-informed. Today, we're diving into something that fascinates and honestly frustrates a lot of people. Predicting stock prices. It's just notoriously difficult, isn't it? I mean, beyond the numbers, you've got human emotion, breaking news, all that social media buzz, global events. It's a whirlwind constantly pushing and pulling market values. So our mission today, we're exploring this really interesting cutting-edge research paper. It proposes a new way to tackle this challenge. They're combining the traditional numerical stock data with all that text information news, social media, you name it. The model they've built is called FTS TextMo, and the promise is that it could offer a shortcut maybe to being better informed about what's really driving market trends. Okay, so let's unpack this a bit. Traditionally, if you wanted to predict stocks, you might use linear regression, maybe ARIMA, Garshich, those kinds of statistical models. These often rely on certain assumptions, right, about stability and patterns.
Right.
But the market isn't always stable, is it? What makes those older methods kind of, well, fall short when things get unpredictable?
Yeah, that's a great question. Those traditional models, they're foundational, sure, but they often struggle because they're working with predefined rules and just pure numerical patterns. They aren't really equipped for the sheer unpredictability, the complex dependencies you see in the real market, and that's where machine learning techniques have started to make a real difference. Unlike the older methods, deep learning can pull in what the paper calls multidimensional, heterogeneous information. Think about like modern portfolio theory, how different assets correlate. Now add human emotion to that. Research keeps showing that sentiment in news, blogs, social media, it actually correlates pretty well with stock trends. Machine learning is just much better at, grabbing those subtle connections and reacting when the market gets volatile.
Okay, that makes sense. And I guess just using a simple sentiment score like positive or negative, that feels too basic. You'd miss a lot, right?
Oh, absolutely.
So what kind of crucial details get lost? And why is integrating this richer text data becoming so, well, essential now?
You're spot on. A simple sentiment score, it's a blunt instrument. You miss out on factual details, specific company news, M&A activity, regulatory shifts, even just the context around why the market is moving. And it's becoming so important because of the sheer speed and volume of information today. It's overwhelming. That's exactly why we're seeing these newer methods, especially those using large language models, LLMs, show really outstanding performance in finance. They can sift through so much more data.
Right, LLMs sound incredibly powerful here. But like any new tech, there are usually drawbacks, aren't there? What limitations did this paper point out with the existing LLM approaches? What paved the way for FTS TextMo?
They did highlight several key things, yeah. For one, a lot of these LLM methods that use prompts, they have limits on input length. They can only process so much text at once. Big problem for fast-moving markets. They also tend to have a kind of restricted prediction horizon, maybe just looking a day or two out. And crucially, many just do binary classification, will it go up or down, not forecasting the actual next price value. Plus, they can be computationally very expensive, costly to run.
That does sound like a big practical hurdle. So, okay, this is where FTS TextMo comes in as a potential solution.
Precisely, that's exactly its purpose. And its core innovation is quite clever, actually. Instead of feeding in tons of raw text, it sorts news and tweets by time. Then it extracts just one or two key factual summaries for each time point. These summaries then get aligned with the numerical data using something called point embeddings. It's like creating a common language, linking the text meaning directly to the stock data at that exact moment. And the critical part, it predicts the actual stock price value, not just the direction.
And it uses this mixture of experts or MOE thing.
Yeah.
That sounds really interesting. Can you break that down? Maybe use an analogy. Why is it important for efficiency?
Sure. Think of it like having a big team of specialized consultants. Instead of one giant brain trying to know everything, you have different experts, each focusing on a specific area. When a new piece of data comes in, a router figures out which experts are best suited for it, and only those experts get activated. It's what they call a sparse technique. Not all parts of the model fire up at once, and that makes a huge difference for computational efficiency and often model performance too.
That's a great way to put it. Only the relevant specialists get involved. And I saw this detail in the paper about its size. It has 113 million parameters total, which sounds huge.
It is, yeah.
But only 50 million are actually active when it's running. What's the real implication there? It's not just about speed, is it?
No, you're right. It's more fundamental than just speed. It means we can build these incredibly powerful, large-scale models without the absolutely crippling compute costs you'd normally expect. It's sort of potentially democratizes access to this kind of sophisticated analysis. That sparse activation is really the key to making it practical.
That really is a breakthrough. Okay, so architecturally, how is FTS Text MOE put together? What are the core parts doing the heavy lifting with both numbers and text?
Good question. Structurally, it's a decoder-only transformer. That's a pretty advanced AI architecture, similar to what powers many big language models, but tailored for this forecasting job. It has three main components. First, input token embedding. That's how it translates both the text words and the stock numbers into a language the model understands. Second, the MOE transformer module itself. That's the team of experts doing the core processing. And third, another key innovation. It's multi-resolution forecasting.
Let's dig into the text processing part, because turning all that raw news and tweet data into something useful sounds complex. How does it do that efficiently?
It's quite a pipeline, yeah. The paper describes how it converts raw text efficiently. First, they use a pre-trained summarizer model, Distilbart, specifically to boil down the news and tweets into key points, just the essentials. Then, they use a tokenizer mini-LM to break those summaries into basic units. And finally, an encoder expert encoder turns those units into numerical representations, embeddings that capture the semantic meaning. So it's a multi-step process just to get the text ready, making sure the most valuable information gets through.
Okay, and what about the numerical side, the time series data?
The numerical data gets processed too, embedded using a function called SWGLU. Then, once you have both the text embeddings and the numerical embeddings, they get aggregated. They use mean pooling, which basically combines them into one comprehensive signal. Then that combined signal goes into the main MOE transformer.
Right. And you mentioned the multi-resolution prediction heads. That sounds really useful. You said it can predict for flexible lengths, 1 step, 8 steps, 32, 64, just by combining projections. Why is that adaptability so important for stocks?
Oh, it's critical because different investors have different needs, right? A day trader needs super short-term forecasts. A portfolio manager might be looking weeks or months ahead. This multi-resolution thing means the model isn't stuck in one mode. It can serve different strategic needs without needing a whole new model. It makes it way more versatile.
Makes sense. And to check how well this all worked, what kind of data did they actually use for testing?
They used quite a bit of data. Stock prices for 55 stocks across 11 industries pulled from Yahoo Finance, then over 637,000 tweets from 2020 to 2022, and also more than 216,000 news records from NASDAQ, updated pretty recently, up to January 19th, 2025. So it's a pretty robust data set.
Okay, so they built this sophisticated model, fed it all this data.
Yeah.
What's the bottom line? For someone listening trying to stay informed, how did FTS TextMo actually perform against other methods?
Well, the results look pretty good. The paper shows FTS Texmo consistently did better than the baseline methods they compared it against, specifically in terms of investment returns and Sharpe ratio, that's your risk-adjusted return. So it seems to translate into better simulated investment performance.
That's pretty compelling. Was there anything that really jumped out about the types of text data used? News versus tweets, for instance.
Yes, and this was genuinely surprising, I think. Adding the summarized social media comments, the tweets consistently led to lower prediction errors, lower MSE and MAE specifically. That means the model's predictions were actually closer to the real stock prices when tweets were included, even compared to using only news.
Wow.
It kind of challenges that idea that only formal news matters. It suggests that distilled sentiment, even from social media, is a really potent signal, especially for short-term moves.
That is unexpected. Did they look at specific industries too? Did text matter more in some sectors than others?
They did. And yeah, sectors like healthcare, consumer cyclical, communication services, they showed much lower prediction errors when text data was included. It suggests those sectors are maybe more sensitive to news flow and public sentiment compared to, say, utilities.
That intuitively makes sense. Sectors driven more by innovation or consumer trends. How did FTS TextMoE's actual prediction style compare? Was it cautious?
Aggressive.
Compared to the baselines they use, like Kronos and Moirai, FTS TextMo was definitely more proactive and aggressive. It seemed better at capturing short-term volatility, trying to predict the quick ups and downs. The other models tended to be more conservative, sort of smoothing things out to minimize big errors, but maybe missing quick opportunities.
Okay, and the ultimate test, portfolio optimization. How did it stack up in building a portfolio?
Pretty well, according to the paper. It showed superior cumulative returns overall, about 0.13, 0.14 return, and better risk-adjusted performance too, with a Sharpe ratio over 1. That's compared against simple, equally weighted portfolios and the S&P 500 benchmark, so better returns for the risk taken. Very impressive. But I guess, With that more aggressive style, is there a trade-off? Did they mention anything about volatility?
Ah, yes, good point. There's nuance there. While the returns were higher, the standard deviation of those returns was also higher for FTS Texmo, around 0.005. So yes, that indicates increased return volatility, which makes sense if it's reacting more strongly to those short-term market shifts, more potential upside, but maybe a bumpier ride.
Right, always a trade-off. Now, even with these great results, the researchers were upfront about limitations, which good science. What challenges did they flag?
They pointed out two main ones. First, this issue of delayed impact. News or a tweet might come out, but its effect on the stock price might not happen instantly. There can be a lag. The model currently aligns them at the same time step, which isn't always realistic.
Okay, that's tricky. And the second one, I imagine it's about the information itself.
Exactly. Misleading information. News and especially social media can have false stuff, rumors, misinformation. If the model takes that bad data in, it's going to hurt the forecasts. They mentioned future research needs to tackle both that time lag issue and find better ways to verify the text's authenticity, making it more robust.
Okay, so wrapping up this deep dive, FTS Texmo really seems like a significant step. It's this powerful model integrating numbers and text, aiming for more comprehensive, more efficient stock prediction, really pushing the boundaries.
Yeah, and its key strengths are definitely that sparse mixture of experts, great for efficiency, and those multi-resolution prediction heads for flexibility across different time horizons.
So this brings up a really interesting question for you, the listener. We now have models like FTS Texmoing that are clearly very sensitive to signals buried in news and social media. But we also know these sources have issues, information lags, potential misinformation. So what does that imply for your own approach? How do you consume financial news and social media? How might you need to adapt your own filters to stay truly well-informed in this landscape? Something to think about.